Hi, my name is Sasha Moore, and I'm delighted to welcome you here today at the 2026 Housing Market Indicators, a live webinar which will be moderated by industry veteran and financial services specialist Nick Young, who is also the Managing Director and founder of the leading trail book company, Trail Homes. Welcome, Nick.
Good morning, Sasha, and glad to be here again.
Indeed. This webinar is going to feature insights from Stuart Musgrave, who's the Head of Advisory Services at Equifax, who will provide some hot off the press commentary from the new Equifax Q3 Consumer Credit Insights report. Welcome, Stuart.
Thanks, Sasha, and great to be here.
Thank you. So the goal of today's webinar is to provide some specialist commentary and analysis on the trends of the rapidly evolving housing market and the mortgage broking sector. So we're going to draw insights primarily, as I mentioned, from the recent Equifax report, but we're also going to overlay this with some recent RBA data. So in particular, we're going to look at things like consumer credit demand, Australian economic indicators, a bit of a snapshot of the last quarter, consumer trend overviews, including mortgage, credit card, personal loans, BP, buy now, pay later portfolios, and auto loan arrears, which very much leans into that consumer confidence piece. We're all going to we'll touch on the financial hardship rates. We'll do a bit of a consumer spotlight in terms of people are intending to buy, build, or renovate. We're also going to look into things like barriers to entry, current first-home buyer hotspots and opportunities, capital cities and regional diverging trends, and as I mentioned, consumer confidence, borrowing patterns, and ultimately what this may mean for 2026. So it's going to be an action-packed session. We love questions. Feel free to send through any questions via the Q&A function or through the chat function, and we'll either address these throughout the session if we're appropriate or answer those at the end. So Stuart, I'm going to put you in the driving seat. We're very keen to understand some of the insights from the recent report. So I'll throw to you, and then Nick, as we discussed offline, jump in, give your lens as it goes through, and we'll just have a chat about the state of the nation.
Thanks, Sasha. And I've been following consumer credit trends for many years now, and so I'm happy to share the insights from the most recent report. So at the summary level, we have seen some trends developing in consumer credit. Some due to economic influences, some due to some regulatory changes that we've seen in the market. But we have seen some growth both in the secured market and in the unsecured market in this calendar year, and some of that is being increased through the new first home buyer grants. We're starting to see some increases in credit demand coming off the back of those changes from the government. On delinquency, generally looking pretty good. I'll go into a little bit more detail of that later. A little bit of change in the 90-day arrears in mortgages and other products, but it's not linear, so I'll take you through some of the detail of that. And we've also done a consumer survey of property buying intent, so I'll take you through some of those details as well. So as I said, looking at the high-level picture of secured and unsecured credit demand, we have seen coming off some negative growth from 2023 and gradually moving more and more positive. But in particular, the last couple of quarters, we have seen that growth starting to accelerate. Some of that has come through in the unsecured market, and as I mentioned, there have been some regulatory changes, which I'll take you through there. But also seeing some strong growth in the secured market as well. So secured up 8.2% year on year, and a good proportion of that is in the mortgage space. Looking at that on a portfolio by portfolio basis, in the secured space, which I'm sure is of most interest to most of the audience today, We've seen some good, strong growth in mortgages, up 10% year on year in credit demand. Not so much happening on the auto loan space, but continuing to tick along there. On the unsecured side, we have seen quite a bit of growth across a number of different portfolios. So cards did take a big dive in the pandemic times and have been gradually coming back, but are still sitting below the levels that we saw pre-pandemic for credit demand. I think there has been a lot of diversification of product offers in the unsecured space, and cards has been suffering a little bit as a result of the multitude of other options that have really come to the fore in the market.
So
We did
Stuart, can I pause you just at that point?
Sure.
Because I find this slide really, really interesting. And we were having a bit of an offline chat about the unsecured credit piece. And I was extremely surprised at the 43% increase of the buy now, pay later option.
Yep.
And Nick, again, we were sort of talking from a general perspective. If we look at what that is sort of suggesting in terms of buyer activity, buyer confidence, buyer sophistication, perhaps any indicators in terms of savings/debt levels. What are your thoughts from that holistic perspective about this very substantial growth in the unsecured credit market? Oh, you there, Nick?
Oh, sorry. I thought you were talking to Stuart there, Sasha.
No, that's okay.
No, I was actually wanting to really ask Stuart that very same question.
Oh, okay. Well, we'll default to
Because
Stuart first.
there does appear to be a very distinct rotation out of, the use of credit cards into buy now, pay later, and it's just seems to be very marked. That, Stuart, I mean, that's clearly what's happening, isn't it?
Yeah, so there's been quite a bit of change in the unsecured credit markets this year. A lot of that was driven by a regulatory change that occurred in June this year, where previously buy now, pay later wasn't regulated under the National Credit Code. They are now regulated as a low-cost credit contract and have a scaled set of responsible lending obligations to comply with. So they need to make inquiries about affordability, and as all of you are familiar, not offer products that will put the individual in significant hardship. So and so that's been a big change for the buy now, pay later market. It also saw I guess the traditional afterpay style buy now, pay later pay in for, where the credit contract is for each purchase. That style of buy now, pay later credit contract has pretty much exited the market in favour of a line of credit style buy now, pay later, where a credit limit is assigned and the individual can make multiple purchases up to that credit limit on the same credit contract. So that drove a change. But I think also because we are getting to a level of maturity in the buy now, pay later market, that with something like 6 million individuals in Australia that use buy now, pay later, we saw the providers of buy now, pay later starting to really look to diversify their product set. So if you look at Zip's website, for example, they've now got 4 different products. And in the way they contract those products, one looks like a buy now, pay later, one looks like a revolving personal loan, one looks like a fixed term personal loan, and one looks like a credit card. So that regulatory change has really spawned a lot of product diversification from those providers in the market, and that has not only underlined the growth in buy now, pay later line, although some of that was a little bit artificial just around that regulatory change date. But it's also spawned a lot of the increase in the personal loan line as well. So
I think you go ahead.
Yeah, we'll continue to monitor how that settles out over the next few quarters, and where the consumer preferences come to in terms of the different offers in market.
Thank you. And I think that you raise a really interesting point about the sophistication of the market and also the evolution of products. And one thing that I was also, when we're chatting offline, that I found really interesting, Stuart, was your overview in terms of the demographics of the buy now, pay later piece, because my impression was that that was very millennial driven, but I was interested to learn of the different sub-segments. So perhaps you can just detail those briefly.
Yeah, so everyone identifies buy now, pay later with young millennials, on their phone buying the next pair of shoes or clothes and the like. And that's definitely a significant segment of the buy now, pay later market. But there's a couple of other segments that are quite prominent as well that perhaps don't get the same press as the millennials. So there is a credit stressed segment. Buy now, pay later providers have historically had quite a broad risk appetite. And so it has been the only credit product that's been available to a certain set of credit stressed individuals. So there is certainly that segment. But there's also a more mature segment as well. More families, older demographics, and more mix between metro and rural that just seem to be using the convenience of buy now, pay later, and the low cost credit option to use as a family budgeting tool. And if you look at even the Afterpay website and their annual reports and the like, their average active customer makes 19 purchases a year on buy now, pay later. So that's getting close to being a revolving credit product for a lot of consumers. So yeah, there's certainly some different use cases and different demographics that have developed in the buy now, pay later market.
Fantastic, thank you. Well, I won't hijack you any further. Back over to you in the driver's seat, Stuart.
Yep. They're looking at some of the economic influences that flow through to credit markets. So inflation ticked up a little bit in the last quarter. So and I know there's been some commentary in market in recent days around the prospects for future changes to interest rates as a result of that. It does seem to have dampened the likelihood of future rate decreases. And the unemployment rate has also, in the last couple of days, come down 10 basis points. So I guess lower unemployment, slightly higher inflation has the economists are saying now is likely to delay any further reductions in interest rates. Nick, you look at the RBA stats intently. Have you got any additional comments on that one?
Yeah, I'll go through them in a second,
Sure.
Stuart, but I totally agree with I actually think the chances of a further interest rate cut have been pushed well back into next year. I'm actually, I'm not even sure we may get one next year, but I'm not in any way looking for a quick interest rate cut in the near term.
Yeah. Yeah, but I mean, there is still, a little bit of optimism in consumer markets. Unemployment remains really low. Cash rates have come down a little bit. Inflation has come down from the peaks from a couple of years ago, and so there does seem to be a bit more optimism coming into consumer markets that they can start spending a little bit more. They can start taking out a little bit of credit to extend their lifestyles. Although household savings do remain at relatively historic low levels.
Well, I guess also that consumer confidence piece is also perhaps reflected in that buy now, pay later, as well as the personal loan in the personal loan stats, and definitely the lenders that we work with in industry, particularly in the asset finance space, have noted that particularly personal loans have become more prevalent as customers are, as clients are starting to feel more confident in the macro or in the general climate, and more comfortable with those lifestyle purchases.
Yep. Yeah. So I'll jump into the individual portfolios in a little bit more detail. So now moving from credit demand to the accounts that have been opened and closed on book. So in the mortgage space, a very slight reduction year on year in terms of the total number of mortgages in market. But the limits on the mortgages in those portfolios and the new accounts that are being opened have increased quite moderately. So we are seeing, I guess, in line with increases in house prices over the last few years, an increase in the mortgages that people are taking out in market. In terms of delinquencies, I think that stabilization in some of those economic indicators has also seen a bit of stabilization in the delinquency rates in mortgages, which is great to see. Certainly, unemployment has a very strong correlation to mortgage arrears over time, and so because unemployment has remained really low and participation rates are also really high, that has helped to put a floor underneath the mortgage arrears, which is good to see. However, we are seeing some of the larger mortgages are going into arrears more commonly, and so we have seen an increase in the total mortgage limits in arrears over the 12-month period.
Stuart, when you're putting delinquency rates together, are you able to go to different sectors of the economy and pick out whether retail is doing better or worse than mining, to take an extreme example, or is it really just an all-up number?
In these charts, it's an all-up number, but we do look at different sectors of the market. Early this year, we did see that there was a disproportionate increase in mortgage arrears in Victoria, and I guess, looking at some of the RBA statistics, that unemployment is sitting at a slightly higher level in Victoria compared to the rest of the country. So I think we're 4.3% across the rest of the country and 4.7% in Victoria. There's been some other economic pressures on government taxes and the like that have also impacted household budgets. So we did see an increase, but that has stabilized over the last couple of quarters. So that's been good to see. In the commercial space, we have seen some increases in insolvencies in a couple of industry sectors. So construction is one of those sectors, and I guess there's been some significant home building companies that have gone into administration over the last 12 months or so. So yes, there remains some pressure in the construction industry. Certainly, going back a couple of years, we did see a lot of increases in input prices that caught a lot of builders off guard, where they had fixed price building contracts in place. So some of that pressure does continue to flow through. Also, we've seen an increase in insolvencies coming through in the hospitality sector. And again, pressure on household budgets means that consumers will look for ways to be able to reduce their discretionary spend. And hospitality is often one of those sectors that sees that decline. So yeah, we have seen some pressure in that segment as well.
And we can perhaps talk about this more, Stuart, but I think that sort of almost goes to the heart of what we're seeing, in that, in one sense, is this great set of numbers. We're all doing well. We're having a lovely time, but we're also cutting back on hospitality because we're finding times tough. And that's the inherent contradiction that I'm seeing again and again in the economy today. But back to you, Stuart.
Yeah, and we do need to, of course, understand that there is a lag time between when we see those economic indicators playing out and impact on the likes of business insolvencies. So some of what we're seeing in the construction and hospitality impact could be as a result of some of those economic indicators playing out from a year or two ago. And the businesses have been able to continue to make ends meet for the last 12 months or so, but have now hit the wall and gone under. So moving on to credit cards, so a slight decline in the number of cards and the aggregate limits in market. Interestingly, too, seeing a drop in the limits for new cards being issued in market. There has been a couple of changes in the providers. So the Citibank portfolio was sold to NAB. A large part of the Amex portfolio, I think David Jones' portfolio, was sold to Latitude. So there has been some of those consolidations that have had some impact in the flow of accounts in the card portfolio. But I guess the gradual decline in cards has been a factor that we've seen in our trends over the last decade. Delinquency rates in cards generally have remained really good. Very slight tick up in the number of cards and the total limits in arrears, but generally continuing to perform really well. Personal loans is where we have seen a bit of change. So we have seen some stronger growth coming through in the number of accounts and the limits in market. And a slight increase in the number of accounts or the limits on new accounts being opened in market. So as I said, there's a lot of activity happening in the personal loan market, particularly with that diversification from buy now, pay later. From an arrears perspective, has remained really stable. We do see seasonality coming through in personal loan arrears more so than most of the other product lines. I guess the generic story there is usually that people overspend at Christmas and take out personal loans to be able to cover that spend. Then once we get into the second quarter of the calendar year, that starts to show through in terms of the arrears rates. Then they start to get back on top of that and get tax returns back and the like in Q3, and those arrears come back down again. So we've seen that trend play out. As I said, slightly up from the previous year, but nothing particularly of concern here. Buy now, pay later. We have seen some change here. So we saw that strong credit demand coming through. That's also resulted in a strong increase in the number of accounts open in market and the limits. And interestingly, particularly off the back of that regulatory change, we've seen an increase in the new account limits being opened in market up quite strongly. Yeah, some of that, as I say, may be a little bit artificial and one-off as a result of the regulatory change. We'll continue to watch how that stabilizes over the next few months. Delinquencies. Now, we did see a new provider providing delinquency information earlier this year, which has had they have a slightly higher risk portfolio than the others in market. So that did have an effect on the overall statistics. But certainly on a quarter-by-quarter basis, it has reduced. And again, some of that seasonality likely to be playing out in the buy now, pay later arrears as well. Auto loans has seen a little bit of increase in delinquencies over the last 12 months, up 21 basis points. and a similar increase in the limits in auto arrears. Hardship has certainly been a hot topic for the industry over the last 12 months. ASIC has released a couple of reports into how hardship is being managed across the industry by lenders, and called out a few organisations for not coming up to the standard that they expect. However, with the reduction in pressure on household budgets, we have seen a reduction in the number of hardships in market. Now, mortgages are a focus for hardship. That's the most common product that people claim hardship on, and I guess it's fairly natural as being such a big part of their financial picture for a household. So it's good to see those hardship values starting to come down.
Now, Stuart, being a Victorian, I just need to pull you up here. I can see that Northern Territory and Victoria are the two states that look to have the worst hardship. Is it Northern Territory's got the worst and then it's Victoria, or I can't quite read the numbers there of the individual states.
Yeah, 0.67 for Northern Territory and 0.61 for Victoria. I mean, Northern Territory is quite a small population compared to the other states, and also heavily influenced by mining, military, and the like. So there's likely to be some impacts related to those particular industries in the Northern Territory. And they often do sit a little bit higher in terms of the hardship and delinquency rates. Victoria, yes, showing a little bit higher than the other eastern states in particular. However, it does seem to be easing a bit along with the mortgage arrears, particularly as some of those household pressures start to come off a bit. I think there's also been some commentary in market around the presence of hardship information on credit files and how that is used by lenders. And I can share some insight there. So hardship on a credit file does not contribute to the credit score. That's a legal obligation that we're not allowed to use that information as part of the credit score calculation, and it's not used as a hard decline by lenders. Certainly in the mortgage space, I've seen that in the conversion rates on mortgage applications that come through. So whilst, as you would expect, if someone's had previous hardship, there is a reduction in the conversion rate for mortgage applications, but it's only around 20% reduction in the conversion rate. So if you do have customers that have previous hardship on the file, do have the discussion with the lender and put those applications up. So jumping into our consumer spotlight. So we run an annual survey looking at intentions around consumers and housing aspirations. So we looked at around 50% of Australians have plans to buy, renovate, or build property in the next 5 years. And interestingly, that has increased a little bit from some of the younger age groups. So those Gen Z and millennial age groups have ticked up in this year's survey. Now, some of that optimism may be coming off the back of the revised first home buyer offers that the government has put out in market. So yeah, certainly that 5% LVR or 95% LVR is quite attractive and does seem to be attracting quite a bit of interest. Looking at what are the main barriers for consumers to be able to get into the property market, unsurprisingly, housing affordability is right up there, and certainly that gets a lot of media attention at the moment. Financial constraints comes in as number two. I guess as a strong relationship to housing affordability, being able to afford the mortgage to be able to service a higher value property is always going to be a challenge. In terms of the credit history is generally less of a consideration, and generally what I see is that mortgage applicants have average credit scores up around 900 on our credit score scale, so that's generally not a concern for lenders. Looking at some geographical information. So the top 5 suburbs by first home buyer applications. We've seen some of the outer urban areas in Western Sydney have certainly seen some good demand. In Queensland, there's some of the outer areas again, and straying down into the Gold Coast is picking up some good demand. In Melbourne, a bit more of a mix. There's a bit more in central Melbourne, as well as some of the new development areas in the outer suburbs. And I guess unsurprisingly, Sydney sitting up there at higher median mortgage amounts compared to Victoria and Queensland.
I think it's particularly interesting that Brisbane's overtaken Melbourne now as the average cost of a house. It's that's only really happened in the last 12 months, and
certainly looking at these suburbs, there is a noticeable difference between Brisbane and Melbourne. Looking beyond where the demand is, but looking at what some areas of each state could be first home buyer opportunities because they are a bit more affordable. So in New South Wales, we see some around the 600,000 mark for mortgages. Outer west, like Emu Plains, down south, like Lumia, could be some opportunities for first-home buyers to come into the market. Queensland, some more affordable suburbs listed there: Chapel Hill, Homeview, and the like. I'm not a Queenslander, so I can't quite say exactly where they are, but also some quite affordable options in Melbourne. So Melton South in the outer west, Keilor Downs, Roxburgh Park, some of those development areas showing some potential for first-home buyers to find a way into the market. And lastly, looking at a matrix of mortgage growth on the x-axis versus the arrears rate. Sorry, y-axis for growth and x-axis for arrears, allows us to compare some of the different capital cities as to where they're sitting. So, sitting above the line with positive growth, the likes of Hobart, Brisbane, and some of the regional and non-capital city areas are showing some strong growth. Regional showing some higher levels of arrears. Brisbane certainly sitting out there, not only showing growth, but also showing relatively lower arrears. On the other hand, Melbourne and Perth showing some muted demand or even negative demand growth year on year, but also those higher arrears. So some of those differential economic pressures coming through in the likes of Perth and Melbourne to reduce the demand as we see that pressure remaining. Perhaps some of that pressure starting to come off to a greater degree in the likes of Brisbane and Hobart and outside of the capital city areas. So I guess that's the end of my deck. I think handing over to yourself, Nick, to look at some of the RBA stats.
Yeah. So I'll just share my screen now with some of the RBA numbers. So hopefully you can see that. Sasha, is that popping up?
Yep.
So
All good.
these numbers were actually released, or these charts were released yesterday. So they're very much hot off the press, and there's people who follow my mutterings. I love following these RBA numbers. So the summary is that it's a damn good time to be a mortgage broker. So I've never actually really seen probably such a good set of numbers, to be blunt. So this first chart is the number of loan commitments. So as you can see, the big hump in the middle here, that was COVID, obviously, but we're starting to get back up to the numbers that were being done during COVID. And if you remember, during COVID, the government was doing everything to encourage people to borrow money. So we're getting back into that sort of level of activity again, which is unbelievable, really. Interestingly, if we go down to the actual dollar amount, so the previous chart was the number of loans, this is the dollar amount. The dollar amount is actually probably now at record numbers. So people are borrowing more, a number of loans, but the size of the loan is increasing. So as I say, it's a damn good time to be a mortgage broker. So again, as you would expect, average loan sizes, we've now moved average loan sizes now moved through 800,000. Now remember, when they think about an average loan size, it's if a borrower splits into 3 or 4 different loans, it's all regarded as one. So average borrower is now borrowing more than $800,000, which is an extraordinary amount of money. If you think that, if we go back to this chart, back into the 2020, people were back down around 600,000. So, that's a 30%, 50% increase, nearly 40% interest in loan sizes in only 5 years. It's a dramatic increase. Moving on, the value of refinanced loans. So again, this is consistent with what we're seeing. It's all about new loans. There is a bit of an uptick in refinance loans, but it's more about new loans as opposed to people refinancing loans. But again, very healthy. Again, a good time to be a mortgage broker. This is what I thought was interesting, Stuart, and you might like to comment on this. This chart here is the value of personal fixed loans. Now, sorry, I'll come on. I've missed a slide here. So here's the value of personal fixed loans. It's showing record numbers. Now, the RBA talks these about being cars. I'm interested because in your numbers there, we didn't have cars going as strongly as this, and it was more about private credit was the one that had really kicked up. Have you got any comment on why there might be some difference between this chart and your chart?
I guess there is some difference in the data contribution that we see. We don't have all of the auto lenders contributing their account information. So there is some gap there. But yeah, certainly it is slightly different from what we've seen, that we have seen more happening in the unsecured market rather than in the auto market.
Yeah, and anecdotally, I'm not really hearing that car sales is booming. So I it's an interesting one, this one. But anyhow, the RBA is saying that we've got a significant increase in personal fixed loans, which is typically, as they're saying here, it's about road vehicles.
Yeah, I mean, it is value versus volume as well. So perhaps there's a bit of a trend to higher value vehicles. I think there's certainly a tick up with EVs and the like in terms of the ticket price.
Yeah, indeed.
So and also maybe there's a flip to more new cars rather than used. That could be another possible impact in there. Certainly, I know coming off the back of COVID, there was enormous demand for used cars, and we saw some really significant price increases in used cars. I think that started to come off a bit now, so
I think that has
maybe
washed through. They're
people
back
are
into new
starting to
cars.
rotate back into new cars, and so
Yeah.
that could underline some of that.
So the final one I thought was interesting, which is again just a great time to be a mortgage broker. So this chart here is the value of new loan commitments for business, and again, record numbers. So you couldn't really get a better set of numbers from what the RBA is reporting. I was, and I'm just going to stop sharing now. If I can work out how to do this. Sasha, there we go.
Well done.
So I'm a genius, aren't I, with technology?
100%.
I was, and I'm going to ramble a bit here now, Sasha, so you'll have to excuse me, but
Okay.
I was looking at the our wonderful treasurer, Jim Chalmers. By the way, I'm cynical about everybody. I don't think anybody's wonderful, but the treasurer last night was at a philanthropic conference with a whole lot of fund managers, and given they were fund managers, he was obviously talking about at a sort of reasonably high level, and he made an interesting comment, which I thought was good. If you put a list of countries together in Australia, and then you run a screen over them and say, okay, who's got a AAA rating? Who's got strong economic growth? Who has had back-to-back budget surpluses? You can hear this is the treasurer talking. Who's got gross debt to GDP in the bottom half of those advanced countries? Who's got unemployment below 5%? And who's got strong business investment? And supposedly, if you run that screen, Australia is the only country that comes up. So Jim Chalmers is saying that, things couldn't be better. And what a wonderful job, obviously, he's doing. And indeed, if you look at the share market, if you look at our real estate market, it's all of these things are just looking awesome. We've got this continuing Goldilocks world of just things couldn't be better. But I then sort of go on to the next step, and I'll be interested in your thoughts on this, Stuart. Yeah, that's right. But inflation to me looks to be, if anything, bottomed. And we're potentially heading back up. If anything, that's where the pressure is actually starting to lift again. Our debt levels, both at a government, but particularly at state levels, are just growing. And I just cannot see anything but a sea of ongoing deficits going forward. And it doesn't look to me like any of, whether it's state or federal governments, with the exception of perhaps Perth or Western Australia, that are doing anything to bring their budgets in under control. So that puts borrowing pressure. That's inflation. If we go overseas, we've obviously just had America work its way through another budgetary crisis, funding crisis. We've got China with some huge question marks with regards to their debt. Europe, Asia, there are some significant debt, government spending issues that are not being addressed there. So worldwide, we're seeing this increase in debt. So all of that again leading back into inflation. So I sort of go, yes, Jim Chalmers, you might be right up till now, but looking forward, the picture looks to me a lot more hazy. And given that we are at these very, very high levels of housing prices, equity prices, I'm just not so sure that we can expect to see the same run ahead during 2026. You'd have to say real estate, it probably is going to go up because we don't have enough houses. I mean, there's really no other way to say that we don't have enough housing stock. So it's putting pressure on housing. It will continue. But the general economy, I'm not so sure. It's a really hard year, I think, to predict where we're going to be this time in 12 months' time. But Stuart, I'm going to put you on the spot. Where do you reckon we're going to be in 12 months' time?
Yeah, I don't think we're in an economic boom time. We have had over the last couple of years some really severe pressure on household budgets. And we seem to have weathered that storm. But some of that will linger in terms of conservatism from consumers in spending, in taking out credit and the like. So it's good to see that we've stabilized after that period, that we've weathered that storm reasonably well. And there are some green shoots starting to show. But it's not all rosy. I mean, we are still seeing pressure in construction and hospitality, and they're big employers. So yeah, I think there's I think cause for cautious optimism, but we will see some trends continuing under the hood. What's going to happen internationally? It's kind of hard to say. There's certainly some risks that could play out internationally. There's a lot of talk about bubbles in AI and crypto and the like, particularly out of the US, and the impact of their tariffs. That could result in some global economic headwinds. But for the time being, I think we're ticking along okay, and it would be good to have a period of stabilization, so that consumers can get back to more of a normal operating rhythm, understand where we're going. Yeah, I think there's a lot of pressure on governments to do something about housing affordability. Supply does seem to be where they're putting a bit of focus, although they are also putting some incentives in front of first-time buyers, which could stimulate demand, which could have a counterproductive impact. But if they can start to get the supply coming through, then at least we should see some stabilization in that space.
Mm. Mm. Interesting. The other one I'm interested in also is productivity, and we're just not getting enough productivity in the economy at the moment. It's been falling. It's marginal whether it's even positive at the moment. It's only really immigration that's holding this country together as far as economically. If it wasn't for immigration, we'd be probably in a recession. And we've got to address that. So again, I just keep on coming back to this contradiction of, one sense where, life couldn't be better. But I'll give you another one. So essentially for my entire working career, interest rates have broadly been falling. When I started, interest rates on a housing loan were at 18%. They probably bottomed during COVID. I don't think we're ever going to probably get back to those sort of COVID numbers. So you could sort of say, oh, we're broadly sort of just muddling along the bottom. But I sort of go, all this international debt, all this domestic debt. We've also got, during my working career, it's always been about globalization. Who can produce a car cheaper, who can produce a bucket cheaper. And we all had the benefit of that. We now seem to be again unbuckling. And that means we're all going to pay more for our bucket or our car, or again, it's inflation. I just don't like any of these trends, and it's they've got to come home to roost at some stage, and probably not going to happen next year. I reckon next year, if you're a mortgage broker, it's probably a good time to be living.
Yeah,
but they've got to come home to roost at some stage.
I did see in some of the statistics that yes, there's some growth coming through in first-time buyers, but there's also some growth coming through in investors as well. So yeah, if investors are coming back into the market, then that's going to be a good opportunity for mortgage brokers and growth in the housing market in general.
So I think to that point, it is a very mixed market. And, we were talking offline, Nick, that, there are quite polarized pockets within the market. So as a broker, and also from a marketing perspective, my instinct would be just to be very, very familiar with your customer base and really be very segmented in your approach and not apply general principles, because as you both were saying, there are some tremendous opportunities, whether that's first-time buyers or investors, growth businesses and other, but equally there are signs of distress or sustained distress. So Nick, at a practical level, what would you suggest to brokers for 2026?
Well, I think, as I say, as for mortgage brokers, I'm bullish. So, get out there, get close to your clients. The numbers were telling you that real estate prices are probably going to go up. First home buyers have been given this great leg up now in the marketplace. The bad news is you're probably going to have to compete with another mortgage broker as opposed to a bank to win that customer. But there's new customers, your existing customers. It should be a good time. You should be out there beating the bushes. You should be making the most of it, because unfortunately there may come a time when it actually gets a lot tougher. But for the near future, I think it's pretty damn good.
Indeed, and I'd add further to that. My favorite saying is, "Don't keep yourself a secret." So make sure that your customers know what you do. And again, I find a lot of the time when I speak with brokers, the customers only associate what you've done for them. So if you're not saying to a first home buyer, I also do asset finance, or I also do this, or I also do whatever, then you're really limiting your market. So my big advice, don't be a secret. Stuart, from your perspective and your sector knowledge, what would be your tips to industry just to really make the most of 2026?
Yeah, I think brokers have a unique relationship with their clients. It's a major financial consideration, and being able to give them good advice and ease the process for applying for a mortgage is a really privileged position to be in. So, understand the offers that are available in market, understand what the lenders need, so that you can ensure that you're putting your customers to a lender who's going to give them a good offer and get that loan through and approved for them. I know the lenders that I work with, they do look at the information that is on the credit report. So, they're looking at what facilities have come through on the application form versus what liabilities have come through on the credit report, and they're doing that comparison to ensure that there's nothing missing. So make sure you've got all of that considered. As a broker, you do have the right to get a copy of the consumer's credit report if that's of assistance to you in ensuring that you're able to put the loan to the best lender appropriate. Sasha, I did notice that there's one question in the Q&A box. Did you want me to jump onto that one?
Yes. So the question that's come in is, banks still need 6 months to 1 year of clear repayment history if a client has had hardship. So my impression is that the case from your understanding, Stuart?
Yeah, I guess we're all familiar with the responsible lending legislation that a lender can only lend if it's not likely to put the individual into a position of significant hardship. So if the individual has been in hardship, they want to be able to see that whatever issue caused that hardship in the past has been resolved, and they're now back on an even keel to be able to afford a new loan going forward. So, that's where the lenders are going to be coming from in compliance with that obligation.
Okay, tremendous. Well, look, we might wrap it there. Thank you so much for your insights, Stuart. It's so interesting to hear what the Credit Insight report has, the commentary and the findings that's come out of that, and Nick as well, overlaying that with that broader macroeconomic RBA lens and ABS data and all of your sweet spots. So it's definitely, the takeout is it's going to be a mixed market for 2026, but as we all concur, it's a fantastic time to be a broker. We look forward to seeing you next time, and enjoy the rest of your week.
Bye for now.
Thanks, everyone. Goodbye.